Let's get some more perspective on the CPI print, what it means for any rate cuts. Former PIMCO chief economist Paul McCulley is with us, now an adjunct professor at Georgetown. Paul, great to have you back.
Good morning. Good morning.
Was this a troublesome print?
No, don't think so. It was a noisy print. We got another disappointment on homeowners equivalent rent, still not telling us what the real world is telling us. But in general, I think it's just noisy, and the underlying disinflationary trend is very much intact. And I do think that rents are going to come down as the year progresses. And the most important issue for the markets is the pivot is unambiguously in. The data have said the Fed is finished. The Fed effectively has said they're finished. The next move is a cut, and it's going to be a series of cuts to take us back to neutral. So that's the theme the market is working on. I think it's the right theme, and the day's data doesn't change that really at all. It's noisy in the data, it's noisy in the market, but we're fundamentally in a soft landing with a pivot already in rhetorically, and we're just waiting for it to come in reality. Timing, pace, and magnitude.
But there is this sort of nagging worry in the back of the market's minds, I think, and probably the Fed, that last mile from 3 to 2% on inflation is going to be tricky and stubborn, and they don't want to cut prematurely and risk not getting there or potentially going the other way. What do they do about that?
I think that's very, very right. I think they're warm and fuzzy, but not urgent to start the cutting process, in part because of the last mile issue. But I think echoing what Mike was talking about is they want to see somewhat softer economic growth and softer labor conditions. And the economy is still strong. It's not, strong like it was a year ago, but it is still strong. So I think they will disappoint, if you will, the market probably all year long in lagging where the market is pricing because of the last mile issue. But also, I think they want to see softer growth, softer labor conditions. And in fact, President Williams essentially said that yesterday because his forecast for growth this year is about 1.25, which implies they need to see weakness in growth and employment in tandem with continued disinflation to have a sense of urgency of the easing process.
Hey, finally, Paul, another complication which we seem to bring up every day now is the activity in the Red Sea. We got commentary from Maersk. That's a fifth of ocean freight right there. Tesco mentioned it. Do you think that gets passed through? And if it does, is it more of an issue for Europe than us?
It's certainly more of an issue for Europe, but I don't think it fundamentally changes the issue in the marketplace, which is the timing, magnitude of the easing process. I don't think the Fed's going to get wrapped around the axle about it. It will, quote unquote, look through it. So I think it's an important variable for the economy and the markets overall, but I don't think it has a keen sort of ability to tilt the train that is down the line, which is the easing process. So we have to watch it, but I don't think it fundamentally changes the Fed dynamic.